Welcome to RBC's Markets in Motion podcast, recorded September 23rd, 2024. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Two big things you need to know. First, valuations continue to look full for 2024 on the S&P 500, but our model argues for upside in 2025. Second, there's a lot of little stuff to talk about right now. We run through a few of the key updates on our high-frequency indicators, including those on the rotation trade, small caps, and the election. If you'd like to hear more, here's another 5 minutes. Now let's jump into the details. Takeaway number one, valuations continue to look full for 2024 on the S&P 500, but our model argues for upside in 2025. Last week, the Fed kicked off its first post-pandemic cutting cycle with a 50 basis point move and an updated set of economic forecasts. And so we've taken the opportunity to refresh the stress tests we use with our S&P 500 valuation model, which forecasts a trailing PE for the index for December 2024 and December 2025, based on views of where PCE 10-year yields and Fed funds are headed. The punchline, our most generous stress test for 2024 continues to suggest valuations are full, and the S&P 500 is already trading a little above where it deserves to be at year-end 2024. But that there are reasons to be optimistic about further upside for the index in 2025, given consensus views for strong earnings growth and more improvement in inflation and interest rates. While we haven't issued an official year-end 2025 S&P 500 price target, it is worth noting that the various stress tests in our valuation model, one of 5 pieces of analysis we typically use in our targeting process, point to the S&P 500 reaching around 6,200 by year-end 25 on our earnings number of 268, or around 6,500 using bottom-up consensus earnings of 283.50. A related fun fact, since the 1990s, the S&P 500's median 12-month gain after a first cut in a brand new cutting cycle has been 11%. That kind of move off the September 18th, 2024 close would also take the index to around 6,200 by next fall. Moving on to takeaway number 2. There's a lot of little stuff worth talking about right now. Here are a few of the things that are jumping out on our high-frequency indicators. First, growth has been attempting to defend its leadership versus value once again, with the growth-value ratio within the Russell 1000 settling into a tight back-and-forth range. Within the S&P 500, income and value-oriented sectors like REITs and utilities have dominated in the third quarter, but some of the big growth-oriented sectors like comm services and consumer discretionary are starting to display leadership again as the quarter winds down. Our bottom line, a messy transition in leadership away from mega-cap growth appears to be underway, but we think it has the potential to stay messy for some time. We continue to see problematic positioning and valuation for the mega-cap growth trade, but note that earnings sentiment, the rate of upward revisions, has been improving for the top 10 S&P names relative to the rest of the index again. The Mag 7 also continues to display slight EPS growth superiority on consensus estimates relative to the index X Mag 7, despite a rapid deceleration in the former and reacceleration in the latter. Moving on to the second big thing, on a related note, Russell 2000 futures positioning on CFTC's data hit a new post-COVID high. This is an important positive development for small caps where net income growth is actually expected to surpass the Mag 7. Even though Fed cuts are a tailwind for this space, we still think small caps need a return of economic tailwinds to take positioning and valuation back to past peaks. And wrapping up, we still see signs that the S&P 500 is decoupling from Trump. At the same time, though, we also see reasons to worry that the political uncertainty that usually proves troublesome for stocks short term may not be behind us. We're keeping an eye on betting market data on the balance of power. On Friday, the scenario that had moved into first place by a minuscule margin was Democratic President, Republican Senate, and Democratic House, while the Republican sweep scenario had faded to second. These shifts stand in contrast with recent hedge fund conversations anticipating a Trump win. That's all for now. Thanks for listening, and be sure to reach out to your RBC representatives with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.